Welcome, everybody, to the October 2024 Reads Report. We're going to start off by looking at the markets in play. One of the big shifts we're going to see is actually in fixed income. If we look at the WAM relative strength max over the last 20 days, you can see that fixed income, all the numbers were in the high 90s, between 96 and 99. Fixed income was plurally strong. Now notice they're in the 40s and 50s. We'll talk about this today, but there's likely been a significant high that's been put in fixed income in the last week. And this high is having ramifications across several other different products. We still have the same kind of environment that's going on in indexes where we have S&Ps making all-time highs, we have Dow making all-time highs, and we have the NASDAQ and the Russell lagging badly. Gold had been on a tear until last week. It has pulled back a little bit in the last week. Same with silver. One of the big stories, of course, is crude. And crude has had a big shift. You can see if we went back 20 days ago, crude was down near its lows. Well, crude now has had a massive shift in relative strength due to the conflict in the Middle East, and it's now 69. We're also going to talk today about the yen crosses. The yen crosses are back in play, and you can see those as well. If you look at dollar and yen in the last 20 days, the WAM relative strength minimum was 2. It was basically near yearly lows, and now it's sitting at 39. So we're going to get in. We'll talk about that a little bit and the shift in the dollar itself. You can see the dollar was at 7. It's now up to 46. So when we look at what's happened over the last month, we see the biggest mover up has been crude, followed by NASDAQ and S&Ps. Ever since the Fed had the 50-point rate cut, NASDAQ has arguably been the strongest market. Now, it had more ground to gain because it was very far behind. But a number of the NASDAQ stocks have started to act stronger since the Fed had the 50 basis point rate cut. Now, on the downside, well, you can see it is all fixed income. 5 years down 43, the 10-year note, the 30-year bond, the 2-year note, they're down 42, and the yen is down 30. When we look, we see S&Ps and Dow are near their highs. Gold is relatively near its highs. Not much. Everything else is kind of in no man's land.
So right now we have markets that are kind of today reacting off the Israeli escalation. We have a number of hurricanes coming still and some bad hurricane damage. And then the NFP report was kind of a shock because the market had been anticipating kind of a mild soft landing type slowdown where the Fed would be cutting rates aggressively. And the NFP report came out at blowout numbers. And so now really, is the Fed done cutting? Is more of a question than that they're going to cut 50 basis points. Bonds are taking a big hit from the stronger economy, and so you've got a lot of volatility out there. Historically, some geopolitical crises mushroom and become much bigger problems, and they can be a shock for the market and turn things lower. But most geopolitical crises end up creating buying opportunities to get aboard the intermediate term trend. So we want to pay attention to whether we're really escalating to a point that it's going to be a big, big impact. And we'll talk about some things to look at in order to do that, or whether this is something that we can potentially use as a buying opportunity. The big kahuna question is, are we going to have a soft landing or a hard landing? We've been talking about this for a while. This is really the key to markets right now. And now we have a third question that's entered in, which is, do we have a soft landing, a hard landing, or a no landing? No landing is soft landing is when you get some economic deceleration, you get some increase in unemployment, but not enough to become self-reinforcing negative feedback loop. And then we get rate cuts and all kinds of stimulus efforts, and things turn around, and eventually the economy hangs on and starts reaccelerating. A no landing is where everybody thought we were in a soft landing, so they started to cut rates and ease policy. And they were wrong. The economy really doesn't slow down at all. And what that generally does, it creates a faster blow off in markets and a faster return of inflationary or some kind of overheating environment that eventually leads the Fed to either have to keep rates high or even start hiking rates again. So remember, we talked about some months back that every soft landing eventually dies. And the two ways that they usually die are the economy just starts to collapse into a self-reinforcing negative feedback loop because unemployment picks up, or we start to see wage pressures or other forms of overheating that the Fed can't ignore. They have to tighten again, and eventually they tighten to the point that causes the recession. So that's really where are we? What's the timing of that? That's really the key question for markets. And one of the reasons we're seeing so much volatility is because the answer to what the high odds likelihood of this question is changing by the day. Okay, remember that we are not in the Nirvana environment that we all wish for, where we're really in a nice intermediate term uptrend, and we got really strong plurality internally, and maybe smaller time frames are starting to be in charge. All those things that lead to this nice, steady, beautiful, sustained uptrend on an intermediate term basis. That's the ideal environment for investing. We're not there yet. We did have supply breakdown, but it came right back into the range and now is above its moving average in negative fashion. And we never got the breakout in the demand index, and we never got the breakout in the spread index. So we're still not in an environment where all the internals are clicking. When we look at the major internals, they look a little better, and that's mostly because they're dominated by breadth indicators. The breadth indicators have moved up to new highs with the market, usually, not always, but about 90% of the time. That means you're not at a high that's going to become a major high, because breadth usually peaks out at least a couple months, and usually 3 or 4 before you get a major high. So we're probably still in intermediate term rally mode. We do have some other divergences. Net points has some divergence, new high, new lows has some divergence, and some other summation index, somewhat divergent but positive. So these guys are positive, more positive than our own indicators, but there's enough divergence there that you can't really say, okay, we are taking off on one of these strong intermediate term rallies that we get when we are really plural on an internal basis. And we can see that with a lot of indexes, right? Here's the main tech index, tried to break out, back into the range, really kind of in a triangle, not clearly clear what it's doing. It's still basing. We look at the Nice index, which has been relatively strong, but it's at the trend channel high and backing off from it. The other thing that really hasn't kicked into gear at all is the VIX, right? The VIX has been playing around with these 20 levels that are negative. When we get our sustained rallies, we usually break below the 14 level and stay below 15 for a prolonged period of time. That's what leads to these nice intermediate term rallies. We're not there. We're playing around between 15 and 20, and today we may be playing around more with 20 again. So we really need the VIX to get back into gear, fall under 14 and break down here, and show us that we're in an environment where risk on is really beginning to come online with more conviction. Now, the markets today and Friday have they had that shock. The NFP report was much stronger than expected. There's a lot of columns out today from Larry Summers and El Arian and some others that are very well-known and substantial economists. They're saying, well, I guess the Fed made a big mistake by cutting rates 50 basis points. The reason they cut them, and they were concerned about unemployment, unemployment's come down. They're worried about the labor market. The labor market all of a sudden looks healthy. And what do you know? We've cut rates at the highest PEs of any rate cut since World War II. So maybe this was really not a good idea to cut 50 basis points. And so the market is grappling with that. But is the NFP number real? That's another question that the market is grappling with. Take a look at how we got that huge number. We had the biggest monthly increase on record of government hiring. And we had huge debt increase. So they're basically spending like crazy. This is potentially more window dressing by the party in power to try to make things look as good as possible before the election. Is it real? Or we'll have to find out later. Right now, the markets are behaving as if they're going to buy them. We'll see after the election's over if we don't get. Remember, this is the BLS that now has the nickname the Bureau of Lying Statistics, right? That exaggerated job growth by over 1 million before recent revisions. It gave those revisions just in time for the Fed to say, oh, well, the labor market really wasn't that strong at all, so we can cut 50 basis points. And then right after that, boom, we get another big revision and increase in the labor market so that we got the most stimulus possible and things look as good as possible. It strikes me as too much coincidence there. Next week, but the problem is, if these are right, and if the economy really is this strong, there's not much need for rate cuts further. And so the market so all the relative strength of the interest rate sensitives and all these kinds of yield curve steepening, all these kinds of plays that people have been making based on data, when the data just turns out to be as good as Chinese data, it's a concern, and it makes it very difficult to know how to invest. And so if people get wrong-footed, you have to adjust. So right now we're adjusting to this NFP report. Whether it's real or not, we don't know. And then the other thing, of course, we got huge increases in oil prices again today on escalation there. We've just had a major hurricane, and now we have another one hitting the shores of Florida. So there's a lot of things there. There's a lot of uncertainty and a lot of volatility. One thing for sure, though, that jumbo rate cut is not going to be coming in November, right? We've had the labor report. The labor report would have to show substantial weakening for there to be a chance of a 50 basis point cut. Now, really, the question is there going to be a 25 basis point cut or not? And the whole curve has picked up. The rates that are eventually expected to be much higher and a higher neutral rate than they expected before because of the strong labor report. Wage inflation also picked up back above 4%. And that doesn't jibe with inflation falling to 2%, actually. And so that's good for workers, it's, et cetera, but not very good for inflation, and it may make a problem for the Fed down the road. The idea that the U.S. is slipping into recession is probably off the shelf for at least a while, unless the data comes back differently than it has been. Now, we got some big benefits from the Fed globally, from the Fed easing 50 basis points. What happened right after the Fed eased 50 basis points? China saw an opportunity to ease policy without killing its currency, and it did so very aggressively. We had multiple rate cuts. We had a fund to buy stocks. We're talking about fiscal spending, and there's even rumors of a potential bad bank to deal with real estate problems. If that's the case, this is really a major turning point for China. But you have to realize that China has come out with stimulus policies 2 times now. It's popped markets substantially, and then after 4 to 7 months, markets come right back down. The problem in China is that they have way too high debt to GDP ratio, and they really can't trigger a credit binge going because of that. And so they're really kind of constrained. So it'll be interesting to see how much fiscal policy they offer, whether they do offer a bad bank, or whether they say, oh, the markets are moving, we don't have to do more, kind of like they did previously, and then markets come off more significantly.